And we are now looking at Persistent Systems. The stock is down, of course, at this point in time, but it has reported a mixed Q1 with revenue and EBITDA broadly in line, but profit missing estimates due to a 105 crore hedge loss. Now, Sajid caught up with ED and CEO Sandeep Kalra to discuss their growth roadmap and the deal pipeline. Here's an excerpt of that one.
We never give revenue guidance. We have said that we want to be a $2 billion company on a run rate basis while we exit FY27, which basically means by March 27, our run rate should be $500 million for that quarter. If you look at the current quarter, we came in at $452 million plus, and we announced a fairly large deal, which is ACV of $125 million, the annual contract value, and a total contract value of $650 million plus. Now, if one was to do the math, it bodes very well for us in terms of revenue growth quarter on quarter and for the full year. And we are pretty reasonably confident of hitting the $2 billion run rate in the time frame that we've set or before.
And how do you look at the EBIT margin part of it? Because that you have said that you want to sustain between 16 to 17%, but a scale up from there, is that possible?
So as of this point in time, we want to be between the 16 to 17%. And if you look at the quarter gone by, and in our earnings call also, we mentioned this. We have also given our employees the salary increase that is due as per our wage hike cycle on July 1st. So anyone who was eligible for salary increase, we have given them industry in line with the industry, the salary increases or better. So we are making sure that we deliver to the revenue growth, build the capabilities that we require to service our customers well as we go along, and that requires investments, and so do these salary hikes, etc. And we are very confident of the 16 to 17% band, and anything more than that, we'll reinvest in our growth.
And what is the kind of impact on margins because of the salary or wage hikes in Q2? And do you expect that to normalize by the time you reach Q3, Q4?
Yeah, so it'll be between 180 to 250 basis points, but we will try to recover it as much as we can as we go along. And for the full year, we still remain aspirationally in the 16 to 17% band.
Another thing which is important to see is the kind of, the quarter has been very hectic for you. Acquisitions, large client coming in, which with an ACV of nearly $125 million. What is the kind of ramp up that you are seeing at your end from a client point of view? And when do you see that acquisition to get fully integrated?
Sure. So let me answer both of these one by one. So if you look at the large deal, this large deal is a software company, a technology company, and we basically are taking over roughly about 20 odd products from an end-to-end product development, product support, product operations perspective. This is also involving a certain amount of employee rebadging. And then over a period of time, we may transition some part of work to India from various geographies. Now, with that, there is no need for a ramp up to be done from a overall takeover perspective. This basically is ramped up day one as we take it. So there was a small amount of revenue in the quarter gone by in Q1. Good amount of revenue from an uptake perspective will happen, and there's some additional work that we have to do on top, which may ramp up over the next quarter. So it should have a significant impact on our Q2. I will not quantify it for you, but from a Q2 onwards perspective, it should have a significant upward impact on our overall revenues.
And so you're saying that the ramp up of that deal will happen in Q2 onwards, and you don't need to have so much of investment there because already you have the rebadging of employees which is coming in there. And can you also give us a sense of how other clients are now looking at the deal? Because my understanding is that many are now looking at outcome-based approach, and when that happens, it becomes a little bit of tricky because become very hyper competitive because cost efficiencies is what companies are trying to pass on to the clients. So how is that environment looking?
Yeah, so I've said it a few times before on our earning calls and even in these interviews. A significant amount of our revenue comes from deals that we proactively nurture with our customers. Even this large deal is a proactive deal. It is not a competitive RFP. This is where we have been working with this customer for long, and we went back with a proactive approach of taking over end to end. So this is, right from the product development, product support, product operations, people, 9 yards. And we have shown to them using our AI capabilities, how we can deliver an outcome based where they are gaining over a period of time. So we give them a fixed outcome while we have the ability to reduce the expenses and make sure that we do the margins that we need to do in this deal. And more of these deals is where we are focused on. trying to proactively go to our customers and nurture more of those deals. So that is the impact there. Now, hopefully this answers your question. Before I go ahead, let me see if you have any question on that.
I just wanted to understand a little more better about this entire AI efficiency gains which are there. Are you seeing as part of that a rebasing of the revenue as well? Because since it's going outcome based, the revenue deflation is coming into the play, but maybe a higher margin coming into the new deals?
Yeah. Yeah. So there is going to be a mix of deals. So this one is a pure net new deal for us. So even if we were to deflate the expense that the customer has, for us, it's a net new deal. And for us, it is about putting, let's say, in a traditional world, 3 years back, we would have had X number of people. Today, we may put 70% of that, and we may, have the productivity go up. And this will happen over a period of time as we kind of bring those AI tools and capabilities from our side into the deal. And similarly, we are seeing in some of the larger renewals, etc., the customer's expectation is whether it is support operations from an application development and maintenance perspective, or it is from the software, you know, development or support perspective. Their expectation is 25 to 30% productivity gains over a period of time is what they're expecting. And from our side, since we are winning more business, it doesn't matter. We can happily, provide the deflation and the productivity gains as we go along while protecting our margins and the growth.
Sandeep, interestingly, what many industry leaders are now talking about is that while Indian IT companies are providing productivity gains to the clients, there is also a cost which is coming in, which is in form of tokens, which are getting used. Now, do you think that will be something which will be a core focus? Maybe not today, because now everyone is in pilot stage. But when you go into a regular contract, tokenization and the cost of tokens now coming into the SG&A expense, that will bring down the productivity gains for many of them, leading to a hybrid kind of model.
So look, the tokens, etc., are real. Now there are choices that you can make. Not for everything you need to use a expensive frontier model. You can use a mix of frontier model. You can use a mix of open source models, whether they are from American heritage, Chinese heritage, certified by MIT and so on, which you can use with the customer's consent. And even the hyperscalers like Microsoft and Amazon and Google, etc., are using these. Now, from that perspective, customers are looking to us to optimize for both the productivity gains and the token cost that comes with it. So in the bigger picture of things, in the future, companies like us and other tech services companies, this will be a part of our goods sold, and our margins will have to be, after this and done well, we can still protect the margin after accounting for such costs. So that is the direction in which longer term we see the direction going.
And the ownership of these basically, do you see that ownership, especially the client's total cost of ownership, is coming down as a result of this entire productivity gain?
Yes. So there are two things that are happening. The total cost of ownership for places where AI can be brought in, and more importantly, on things that are repeatable, that are like support operations, whether it's applications, product, and so on and so forth, that is going down significantly. Part of that is being taken into revenue bearing applications or revenue bearing, initiatives, leveraging AI or otherwise. And so from that perspective, you will see the customers gain from this and ultimately redeploy part of this back into their own competitiveness. And hence, the players who adopt AI are able to work with their customers closely on this. You will see them growing fairly well as well.
Interestingly, what you saw in the quarter is an improvement in attrition. It's come down to 12.3%. Is it because of the kind of client ramp-ups that are there and the wage hikes that you are given? What kind of average wage hikes have you given compared to industry?
Yeah. So if you look at the wage hikes, they'll be in the range of about 6.5% on the India side, about 3% on the global side of it. That is the rough range, give or take, and it depends on individuals, but that is the average, if you may say so. Now, if you look at it, why is the attrition down? Number one, the kind of work that we do. Number two, our initiatives within our own company on employee engagement. Number three, we are one of the few companies who have given more than 100% bonuses, even in this environment. We are growing, we can afford to do it. Many companies are having tepid growth, maybe they can't afford to give, and we have maintained our commitment to our employees on the salary hikes on the day it was due for all eligible employees, not for a few, but for the full company eligible employees have been given the wage hikes. So from that perspective, our employees believe in us, trust us, and the growth keeps entire aspirations from a career path also alive at a bigger scale.
Finally, Sandeep, if you can also give us an update on Nagaro acquisition. It's expected by the end of the quarter. How is Nagaro performing as we, because that integration will take some time, but what's the kind of performance Nagaro has been doing?
Yeah. So from a Nagaro performance perspective, look, we are arm's length. We cannot commit or comment anything on that because we are not involved. From a regulatory perspective, till the time the deal closes, we cannot have any kind of interference in each other's operations. We cannot collaborate or anything. We have to go through the regulatory approvals. We are going through that. They may come in the Q4 of this calendar year, which is Q3 for us, or in Q1 calendar for next year. As that comes in, we'll start the collaboration, and we believe with Nagaro we have a very good combination happening, and it should be very well received by our customers, leading to good revenue acceleration on the Nagaro side as well, as you have seen on the Persistent side. And we'll keep you updated as we go along.